Hey everybody, welcome to Mortgage Today for Thursday, September 28th, 2023, and oh, what a day it was. MBS opened up the day down 1/4 of a point. Again, S&P futures were down 5.5 points. Bonds pushed into moderately weaker territory overnight in perfect lockstep with European bond market weakness. There was a small pushback ahead of the data and additional gains afterwards before the market corrected itself and then radically changed later. Global sovereign yields are shooting higher than the morning, led by the UK with a 18 basis point pickup. The German Bund yield was up 12 basis points despite a better than expected inflation report. Rising energy prices aren't helping things, and all of this was translating into relentlessly higher Treasury yields in the overnight. Then we got the Jobless Claims, which came in at 204,000 on a 215,000 estimate. It was 202,000 previously. GDP final came in at 2.1 on a 2.1 forecast. It was 2.0 previously, so the economy is still expanding. Consumption was revised downward, while non-residential fixed investment was revised upward. PCE price component rose 2.5% and 3.7% on the core. GDP Deflator was 1.7 on a 2.0 forecast. It was 4.1 previously. It is looking more and more like we will get some sort of government shutdown soon. The last time we had a full government shutdown, the IRS wasn't sending out tax transcripts, which delayed some closings. So think about that in advance. Pending home sales fell 7.1% in August, according to NAR. Euro-REO transactions are down 18.7%. Bond lost ground overnight and logically added to the losses after the morning's jobless claims data. Dovish comments from Fed School helped push back in the other direction, and month-end trade flows added to gains in the afternoon. All told, it was a token correction, much like Friday's, but one that had more of a foundation on relevant market movers, like new ideas from Goolsbee and the Fed possibly being able to claim some victories on inflation without needing to visibly damage the labor market. The other day, they up 33 basis points, a total of 55 basis points in market moves from the low to the high, which puts us right in the middle of that still ugly range. And also another commentary, what about the government shutdown? Isn't that supposed to help bonds? Aren't we supposed to be seeing a flight to safety? Yeah and no. I mentioned the other day that unlike past scenarios where we've seen a shutdown, any help we do get will simply be to slow down this F-rate train, and it isn't going to drive rates lower. What it will do is delay the publication of any economic data, JOLTS, jobs data, non-farm payrolls. So while the shutdown is looking more and more likely, don't look for any help from it.